Right. Sorry for the delay that due to the technical matters. Right. Those who are online, can you hear? Can you see? Yes. Those who are online, can you hear? Okay, fine. Right. As we discussed in the last week, so we are planning to discuss today very important aspect again. We have a basic discussion. We had the basic discussion on fair value accounting. So I'll be taking the rest of the things through this PowerPoint and the other research articles as well. Right. So as we discuss, as we have planned, what I am trying to do today is fair value accounting and social responsibility accounting, right? Or social accounting. So that point of view we supposed to discuss. And apart from that, so just to make a revision on what I have discussed with you under this subject, I have put some questions. So everything uploaded to the LMS, you can look into that, right? So in this subject I will be taking only 3 lectures. So this is the third session. So after that again Mr. Saman Bandar will be taking the 2 more lectures are remaining after this. So that will be taken by Mr. Saman Bandar. So you have been given the assignments and all the things, right? And again just to remind you, so for auditing you may have the presentations on next week, right? Next week. Okay, I think all that information and further email also sent to you, I mean regarding the assignment and for auditing, right? Okay. Right. So as we discuss, just to recall, just to remind, so what is fair value and what is historical value or the cost, historical cost, right? What is fair value and what is historical cost? Is it same? Yes. What is better? Historical cost or fair value? So those are things we want to discuss. Earlier we know that, so once the transaction took place, so we have recorded on the cost we have incurred or how much we have paid to acquire that particular asset or to settle the dues or whatever the liabilities, obligations, right? So that is basically historical cost. So that is, everything based on the transaction uh, we have transacted, right? So let's say a few years back we have acquired a land machine. So our accounts, so our financial statement shows that what the amounts we have paid, we have how much what's the cost we have paid to acquire that particular asset or construct that particular asset. So that value and in terms of today's value is totally different sometimes, right? There may be deviations. Sometimes market price is lower than the cost we have paid. Sometimes market price is higher, right? So therefore what happened is, so if we go with the historical cost, financial reporting or financial statements are not showing the current picture, current situation, right? Therefore, so as you know that, as you have taught in our subject, so even financial accounting standards in IFRS and IAS are suggesting you to, for what? To look into what? Sorry? Fair value. Fair value. Very simple reason is it will give you the more relevant information, right? More relevancy for the financial informations. Yes or no? Yes, because it tells you the current situation. It tells you the current situation, right? But the thing is, when it comes to the fair value, how do you get the fair value? So basically the fair value means what? Fair value means what? Yes? Sorry? Today. So what do you mean by that? What is that? Time value of money? Yes? What do you mean by, very simply, what is fair value? Very simply, market price. Market price. Very simple definition. I don't say that is, the exactly same as that fair value and the market price is the same. No. But basically, the fair value means the market price. There is a deviation, there is a difference. But basically, the market price. The thing is, when it comes to the market price, some assets are not exchanged in the active market. Then what we have to do is, to value that particular asset, what we have to do? Sorry? Huh? We have to estimate. Right? Let's say you have a land. Is it trading in the market? Huh? 12-acre land you have. Is it trading in the market? Basically no. Then what we have to do is, we have to take the professional value and value the land value and record on that. So then it's an estimation. So therefore, to what extent that estimation is correct? Right? That is I don't say it is wrong, but again there is some sort of error for margin. There is a margin for error. There is a margin for error. Right? I don't say it's wrong. There is a margin for error. There may be deviations. Do you agree or not? There may be deviations. Yes. That part is there. So if it is there is a market and it's actively traded, no issue. Right? So then you know exactly what is the price. Let's say you have purchased the shares in the share market. So now you know what's the market price exactly, no issue. The thing is, most of the assets are not traded in the market. So that is the challenging aspect of that when it comes to the measurement, valuation. Right? The other aspect is, when it comes to the market price, it's frequently changing. Volatility is there. Right? How do we decide the market price? It's purely based on the demand and supply. Based on the supply force and the demand force. Yes or no? Yes. Right? Anybody can put a high demand. Right? So then market prices are going up if they want to do so. Right? So then anybody want to reduce the market price, more supply. Then there is again room for the manipulations on market price. There is a chance of manipulating the market price. It's really volatile. So if we record on the today's market price, tomorrow's market price is totally different, maybe. We don't know. So therefore, again, when it comes to that financial reporting on the market prices for assets and all the other liabilities and everything, so it is changing day by day. So then what's the amount we supposed to record? Therefore, it's, again our financial statements also getting, some sort of volatility. That, that challenging aspects also there. So those are the negative aspects of fair value. But again, so we can sort those things, we can sort out those things if we have the correct, or if we have more appropriate estimations, right? And with the proper disclosures in the financial statements. So then everybody knows that. So this is how we have calculated This is the method we have used. So then the user can decide whether this is appropriate or not, right? That's why you have more and more disclosures. Therefore, the suggestion is to have more and more disclosures and go with the fair value, and to take more and more appropriate fair values for your measurements and valuations. Because historical cost is okay, it is very much verifiable, it's a very solid amount, right? But again, it's all about the past, not the current situation. It doesn't, those financial informations are not giving the current situation, the relevance to the financial informations of the company or the business. Therefore, fair value is good, it's all right, but again the problems are there, right? Therefore, we should plan, we should work to reduce the challenges behind the fair value, right? So that's what we're supposed to do, right? So it tells you from the origination of the account in the historical cost is used to as a way of recognition, recording transaction in a business. Yes. Later, to facilitate the relevance of the account information, the fair value concept was originated. Okay. Right. So we know that what is the cost? Cost is the amount of cash and cash equivalents paid over the fair value of the other consideration given to acquire an asset at the time of its acquisition or construction. But again, fair value is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. This is the older definition. So now I will be taking the next definition. So as per the standard, sorry, this one, this one. Then we can't see that others, we can't see the others comments. If you put the slide show, view show, right? IFRS 13 or SLFRS 13 defines. So this is the new definition. That's the earlier one is I also put. So defines, you see, fair value as the price that would be received to sell an asset in an orderly transaction between market participants at the measurement date. You understand this very clearly. Fair value as the price that would be received to sell an asset in an orderly transaction. Very simply, what is that? Market price. So the value as the price that would be received to sell an asset. Or the other side is the how much we are paying to acquire an asset. Right? In an orderly transaction, what is that? Orderly transaction. So in the previous example, you see that arm's length transaction. So this is the orderly transaction means what? Again the arm's length transaction. So because the two parties are doing the transaction as a normal course of transaction in a normal course of business. So there are no related parties. Why? If there are related parties, what happen? The prices may be high or low. So therefore, what is important is, so you should have the normal course of transaction which will happen in the normal course of business. That is orderly transaction. Right. So the fair value, again another definition as per GAAP, generally accepted accounting principles. The fair value of an asset is the amount at which that asset could be bought or sold in a current transaction between willing parties other than liquidation. So liquidation, again, very extreme case, it doesn't give the real value of the asset or liability. Right. The value of a liability is the amount at which that liability could be incurred or settled in a current transaction between willing parties other than a liquidation. Okay. So this is what we discuss. With today's unpredictable market conditions, investors need to know what an asset is currently worth rather than what was worth when it was acquired. So that is again fair value. So when it comes to the market price, or that when it comes to the fair value estimations, so if you have quoted price in the active market, it's yes, of course it's very good measurement. Quoted market price in an active market is the best evidence of fair value and is used as the basis for measurement. Many times quoted market prices for an asset are often unavailable. That's the issue. An estimate of fair value can be used. As a result, difficulties can occur when making estimates of fair value. That's what exactly we discussed, right? Nothing new. When there is active market, of course, obvious market price. No active market, right? Then what we have to do? Most recent market prices for the class of assets. So most recent transaction prices, market prices for similar or related assets, sector benchmark or rules of thumb, net present value of expected future cash flows or net realizable value. So that type of criteria. So the basis you can use to estimate the fair value, right? Let's say if you want to sell the land, if you want to sell your land, first then you have to decide the price. How do you decide the market price? Huh? Professional valuers. Okay. Apart from that is for a company. Or personally, you want to sell your land. First, where do you want to look into? Huh? So what's the price sold by the? So that the lands which are near to that particular land. What is that? Right? Market prices of similar or related assets. Right? So that type of basis you can use to estimate the market price or the fair value. Right, so as we discussed, if you don't have an active market, so basically as per IFRS, we have to go for the present value of future cash flows, right? So then again it's an estimation, so you have to have more appropriate and appropriate and adequate assumptions, right? That is what is talking here. So positive side of historical cost, definite, yes. Immediately determinable, readily verifiable, reliable, comparability is a matter. So those three basic aspects are there. But to all no relevance, misleading financial position. Those are the negatives. Right? Positives of fair value can provide more transparency than historical cost based measurements. Reality, it tells you the reality and the relevance. Negatives less reliable because we can't prove that. Verifiability is somewhat less. Make financial statement more subjective, too volatile, increasingly difficult for comparing companies for investments. So that type of negative perspectives also there. Volatility, as we discussed, there is a volatility with the market. But again, with the proper disclosures that can be resolved. These are some examples are given, so nothing to worry about that. You can just go through with that. Right. So these are simple things, but we have discussed, nothing to go through with that. Historical cost, it's very difficult to compare, right? Because it's about the past. So what is required, as we discussed, you should have the more and more disclosures. That's why you will have this much of pages in the set of financial statements in an annual report. Why? It includes what? More and more notes, accounting notes, more and more disclosures. It is what is required. So as we discussed, if we have fair value with the more and more disclosures, it will give you the more informed decisions, more comprehensive information for the stakeholders to make their decisions, right? That's the conclusion on this discussion. That's why all accounting standards suggest you to get the fair value. Fair value. You discussed investment property? Yes or no? Property, plant and equipment? Financial instruments? So what do you suppose to get? Fair value. Share based payments? Yes? Fair value. So all the standards talks about finally what? Fair value. So basically revaluation of property, plant and equipment, what's that? Fair value. Impairment of assets, what's that? Get the fair value. Right? So all standards support you to get the fair value in the statement of financial position. Why? To get the relevance, to get the reality to the financial information. Right? Okay. I am not going to discuss everything on that research article, but just to give you the basic understanding on what we have discussed through that research article as well. So I will take the important points. So if you look into the abstract, so it tells you this paper aims to discuss fair value accounting and its usefulness to financial statement users. The European Commission has recently endorsed IFRS 13 on fair value measurements, and it's considering the endorsement of IFRS 9, which extends the use of fair value for financial instruments. Furthermore, fair value accounting has been under deep scrutiny because of its alleged role in the financial crisis. Therefore, the usefulness of fair value accounting is a key issue for standard setting purpose. Right? So, what's the finding? We'll see. Empirical research raises some doubts on fair value reliability. Furthermore, the fair value accounting alone cannot provide information useful to evaluate stewardship. Historical cost is also needed. A dual measurement and financial reporting system could therefore deliver more complete and useful information to the financial statement users. Right? So what's the research is talking about? So as we discussed, fair value accounting, yes, of course, good. But again, practically, it gives some sort of what? Some sort of what? Doubts on fair value. Doubts on fair value. Because the auditor, even in what? In the challenging situation, to conclude on the fair value. Why? These are all on estimations when it comes to the non-active markets for those assets and liabilities. So therefore, so as the auditors, even they have to rely on what the management is telling, right? So therefore, there is a chance of manipulating the fair value. That's why you may have a doubt on fair value. So therefore, what is suggested in this research article is what? Go with the fair value and the historical cost, both keeping together, right? So it's somewhat contradicting with fair value accounting with the IFRSs, but the researcher concludes like that. So actually nowadays it's coming like that, So fair value accounting creates a lot of issues. I will take another research article. So create a lot of issues on economies in the whole world, right? So one of the issue in the we have discussed prime mortgage issue in US. So that now identified that one of the reason to have that issue is what? Fair value accounting. Well, I will go through with that research article. So therefore, fair value accounting is very critical, not only for that particular stakeholders or the shareholders, for everybody. And again, if we are not using properly that fair value accounting, right? So what can happen? Even whole economy can be damaged, right? To that level, this the concept is severe, important, very serious, right? I will show you the research article. Right, I will take that research article now.